Hello, and welcome to the second part of our recorded section of the course. And this is the final part of the lecture on international financial crises. We'll continue talking about what you can do to avoid them, and then we'll move on to talking about managing them. And then we'll also end up talking about the most recent financial crisis, international financial crisis, which was in the 2007-2009 recession. It became a global recession. But let's go ahead and talk about avoiding them right now. So this part of the discussion, we're just building on the last part where we discussed the possibility of having capital requirements to avoid a crisis, where you'd want to have an owner or a stakeholder have equity in a business so that they'd care if the business went under. They would actually lose some of their own money. So you can tie their own interests into the risks that the business takes, and they wouldn't want to take unnecessary risks and that might lose everything. And you can have them, you can require them to have capital and ownership in the company, either physical capital, or maybe have the company retain some of their earnings, so they can't take the earnings and put them into a more secure and different asset. This builds on that discussion a bit, and we also talked about the crawling peg and how that can cause problems. So now we can talk about a little capital controls, so government intervention into the economy. Remember, we keep on coming back to these capital flight scenarios in which foreign investors, get skittish and remove all of their investments that they had made into an economy. This can be really bad for a developing economy. We sometimes will refer to this as sudden stops, where the capital flows into the economy will stop, and then sometimes reverse. And this is really bad if we're talking about portfolio investments. If the small economy had relied upon a lot of sales of debt, so selling bonds and also issuing stocks, then that inflow of money will stop. They won't be able to sell their bonds anymore. They won't be able to sell stocks anymore. In fact, the value of those bonds and stocks may fall essentially as they're sold. And so it can cause a lot of problems. Those are inflows. We might want to talk about controlling outflows or both. So what we're not talking about here are the type of capital flows which support exports or imports. If you're a large company, you may lend to a customer, which allows them to purchase the items now. So they essentially just, you allow them to pay you later. That's a capital flow. You are issuing debt to that customer, and they'll pay you later, sometimes with interest, maybe not. That's not what we're interested in here. Although this is significant, it's worth noting that no one suggests controlling those type of capital movements. So the allowing a customer to have an account with you and pay you back at a later date is not at issue here, although some of those are loans with interest. So that's just lending to allow purchases of goods and services. We don't want to limit that at all. That would prevent exports and imports. It's not what we want to do. What we might want to do is control outflows if our domestic investors are not reinvesting enough of their money into our domestic country. We may want to limit the outflows, so the amount of portfolio investments and direct investments they can make abroad. We might want to slow that down. It's really hard to do that, though. The investors and companies find ways around it. One way is to overpay for the goods and services that they are importing. So they can purchase abroad. They can pay more than they would, with the understanding that that excess money will be considered to be an investment into the foreign company. So that's one way you can have an outflow without it being detected. The other is just direct bribery of officials that allows you to circumvent the limits on foreign investment that are supposed to be in place. So these are very difficult to do. There's always ways around sending money abroad and investing abroad. Limiting inflows is a little easier. It's easier to monitor the money that your domestic companies can receive. So if Ford receives a ton of cash from a Japanese investor, they need to report that. They need to pay taxes on that, and we can monitor it more easily. So inflows are more easily monitored, and these are often what we are interested in. Maybe not necessarily in the United States, but a smaller developing economy may want to limit these to avoid sudden stops and avoid periods of capital flight in the future. It will slow down their growth, but it'll help them avoid a crisis in the future. So that's one thing that might be possible and is done. Now, after a crisis has occurred, we need to figure out how to manage it. And what you do depends upon what caused it. The instance in which it's caused by one of these macro imbalances gives us an easy answer, an easy solution. You just do the opposite. If you had been running large trade imbalances, importing more than you're exporting, well, what you might want to do is weaken your currency, depreciate your domestic currency. That means it would be more difficult for domestic importers to make purchases of foreign goods and services. So when you weaken your currency against a foreign currency, well, that foreign currency will also strengthen. So they would be able to purchase more, and that might fix a trade imbalance. If there's a fiscal imbalance, a budget imbalance, then you need to either get more taxes or cut spending. So those issues are pretty direct. For capital flight, it's a little more complicated. The financial system, especially today, is very complex, and the sources of the problems are various. So one thing to do for capital flight is maybe to raise domestic interest rates, restrict credit, make credit more difficult to get domestically. Usually do this by decreasing the money supply, which will increase your domestic nominal interest rates. So this will attract foreign investors and keep that money, keep money coming in. So that could keep capital from going out if you have a higher domestic interest rate. So the interest rate represents these return to your domestic assets, and that keeps foreign investors buying those assets. And it also prevents your currency from depreciating. Remember how the exchange rate crises can really accelerate any capital flight by making it so that the expected return on a foreign investment is lower because that currency might be depreciating. If you can keep demand for your currency at a decent level, that won't happen. And you can do that by having a higher interest rate and making it interesting for investors to purchase your assets. There's a limitation, though, when you keep your interest rates high. That makes it difficult for borrowers. People investing into the economy, those are lenders, people who have money and want to lend it to individuals. And the borrowers are going to be individuals who pay that interest rate, that high interest rate, and take that money and create a company. They borrow that money and create a company. So entrepreneurs may want to do that. Not only create a company, but existing companies may want to expand, and they'll need to borrow to be able to do that too. But they'll have to pay a higher interest rate. And that slows the economy. So you may prevent capital flight, but it could cause a recession. So the international system that we've been talking about, which has emerged after the Bretton Woods conference, and it's sometimes referred to as the architecture. So that's what we're talking about here with financial architecture. Should we reform that in order to address financial crises? There's two main issues. Do we need a lender of last resort? So what's the role of the IMF? And also, what conditions should any kind of lender impose if they are a lender of last resort? Should the IMF make loans with conditions? So the first issue here, this lender of last resort, well, we talked about the main problem, and that's moral hazard. If we have a lender of last resort, people know one exists, they may take risks, they may hide the risks that they're taking, and that's by definition moral hazard. So knowing a lender of last resort is there will cause you to take more risk. Some things that are associated with this are the idea of quotas. So we try and get people to have stake in the IMF, put some of their own money down. So that's what a quota is. In order to be a member of the IMF, in order to receive any loans from the IMF, you have to buy into it. Now, these quotas are actually fairly large in the level or nominal terms. We're talking of billions and possibly trillions of dollars into the if you're in the United States, I think it's the only country that has that high of a quota. Otherwise, it's in the billions of dollars. So it's a large amount of money, but it's not enough if you're going to use that as a limit to the amount that in those countries can receive. You do need that full amount or more in order to really help a large country. And by large, we're talking about Spain or larger, so not the United States scale. The IMF really couldn't do much to help the United States. It may be able to help certain segments of the economy, but not the entire thing. There need to be additional help. So that's one thing about the moral hazard. If people are aware of the limitations of the IMF, and in fact these quotas may limit the amount they can get, then that limits the moral hazard. The other side of it is these conditionalities, these conditions. So these conditions started to get more diverse and kind of more active in reforming economies after the 1970s. So after the 1970s, in order to receive a loan from the IMF, you had to really reform your domestic policies, often your fiscal budgeting policies. This causes lots of controversies. So some of the conditions involve privatization. So if the government is involved in producing goods and services, it must sell off those companies in order to receive any IMF bailouts. These types of conditions become very controversial in Africa. A lot of the governments in Africa are involved in providing public water to their citizens. Water is essential for life, obviously, and they are asked to sell their water companies and make them private. And the private companies then charge citizens for access to water. So this is obviously controversial, that extent to the privatization. There's been pushback since then, since the 90s, and this does not necessarily happen that much anymore. There's also redesign of social policies. So how extensive is the health care? Who gets education subsidies? There's cuts in spending, obviously, many times there. So there's other domestic changes then, and who may get child care policy. You may get child care from the government and other social issues. So these are become heavily criticized after the 90s. It seems heavy-handed to require a domestic economy to cut these programs or sell them in order to receive a loan. On the other hand, these cuts often do make it easier for a government to pay back the loan because they're not spending as much. They can allocate money to pay back these loans. So there's this controversy there, and some of the conditions have been loosened. somewhat recently. So the end of this, we're just going to talk about the 2007-2009 crisis. This started in the U.S., basically. I guess you could say it started in the U.S., maybe parts of Spain, Ireland, Portugal, and Greece, areas in which real estate had been booming. A lot of people have been buying houses in these areas, especially where there were vacation spots. So outside of Las Vegas in the United States, Florida, especially, then warmer parts of Spain, vacation spots in Greece, Portugal, nice areas around the Mediterranean. Saw a lot of investment going on. Ireland isn't a huge tourist destination, although a lot of people like to go to Ireland for tourism. A lot of it had to do with just the growth of the economy. The Irish economy was one of the fastest growing ones. Real estate was a big part of it. And there's commercial real estate as businesses grew there and moved into Ireland, which also were driving up prices. So these housing prices increased. People just wanted to issue loans to whoever, allow them to buy a house, because it didn't matter if they paid back their loan. If they defaulted, then the issuer of the loan received this house, which was a valuable asset because prices had been increasing. So they're lending it to anyone, and that's what I mean by the subprime crisis. Subprime borrowers were individuals who had either poor or no credit history. So no credit history is almost the same as having poor credit history because it's uncertainty that's associated with it. So we lended a bunch to those individuals. Of course, a lot of them defaulted on their mortgages. People default on their mortgages, then actually there's a lot of houses being sold, and that drives down the price. And so housing prices do fall. Then what had happened is that these loans had been taken and flipped. So I would issue a loan, for instance, to an individual. I would then turn around after charging certain fees and sell this loan to another investor who is going to take that loan and package it with others and turn them into a bond, a type of bond that people can buy. That's called securitization. So all these mortgages are sold and packaged so that people don't pay back the original lender. So if you have a home mortgage, you don't pay back the original person who lent to you. You pay back somebody else who has packaged that mortgage into a bond with others and has sold pieces of it to other people. So these these bonds are all spread throughout the economy, so that when home values plummet, the value of these bonds plummet, and then there's rapid contagion because the prices of these bonds are plummeting. People are selling these bonds. So even if you made decent amounts of investments and made smart investments and you weren't selling your bonds, the value of them was collapsing, and so was your balance sheet. So the securitization then is this just packaging these loans and selling them as bonds, selling shares of them. So again, what happens is the mortgage payments go back to this package instead of the original bank. The original bank could care less if the mortgage borrower does not pay back their loan. It's not their concern. So you could lend to anyone. So these derivatives collapsed, and then when the housing value collapsed, and it was a big mess. So with the United States, and also in areas of Europe, like I mentioned, Spain, Greece, and Ireland, a lot of the money wasn't coming from domestic sources, but international sources. Part of the reason why this occurred wasn't just because those people in the United States who were issuing mortgages and flipping them. A lot of the funds that they were getting to issue mortgages were coming from international lenders, and because of what was called the global trade imbalance, and then global financial imbalances. So let's look at what we mean here by financial imbalances. So we have surplus countries and deficit countries. So the surplus countries, we're talking about a surplus in their current account balance, Remember, when you have a surplus in your current account balance, it's likely because you are exporting a lot more than you're importing. So you're exporting, you get a bunch of cash from your exports. With that cash, you can now take it and send it out as a capital outflow and invest it into another country. And that's where this money is coming from, to being issued as mortgages. So China's up there, Germany's up there too, and Japan has the largest positive current account balance, meaning that they'll have a lot of cash to go invest around. So Japan has really high savings rates to boot. And Saudi Arabia has a lot of cash coming in from sales of oil. Russia also, oil and gas to Europe. Germany is kind of an outlier. A lot of their money that they have is from exports that they manufacture. They have a big high-tech export manufacturing industry. The deficit countries, United States, so we're running large trade deficits. To fund this, we have to borrow. So we've got Spain in there, UK, Australia, and Italy are all borrowing. Italy got caught up in this too. Nice, warm Mediterranean climate. This was a source of this global current account imbalances, and financial imbalances were part of it too, that because the surplus countries had to do something with this cash and wanted to look for investments, and those would come back into the United States, for instance, and Spain, in the form of mortgage lending, and then those were flipped to create these securities, which lost all this value. So when everything blew up, then the entire globe was sent into recession. But this was part of it, not just the mortgage lending, although both were causes. Okay, that's the end of this section, or actually the end of this chapter. Hope it helped.